Hello, welcome to this video. My name is Martin, and in this video I'm gonna show you how I use principal component analysis in R for portfolio diversification. What I'm gonna tell you is partly based on this one book called Multidimensional Diversification. I believe it's in Amazon. Here it is. It's by a guy called Dr. Rankin, who is a portfolio manager. And his book, that is very short, it only has 47 pages, is a very brief intro to the topic. So what I'm going to do is I'm going to apply PCA on index data from MSCI. First off, I'm going to get data from this website where you can download end of the day data for the MSCI indices free of charge. If you're not interested in data preparation, which I'm going to do next in R, you can skip by a couple of minutes and go to the PCA part straight ahead. But anyway, let's select some nice data. Let's use country, and first off we select, I want MSCI world value. I want, let's use Norway value. Let's use some emerging markets. Let's use Brazil, but not value. Let's use Brazil small cap. Oh yes. And what else do they have? Style, suit. Let's have some minimum volatility, because I believe these are not too bad of a diversification. So let's have developed markets, regional, all country, world index, minimum volatility. And let's have some developed emerging markets, BRIC, but we don't want the BRIC minimum volatility. Let's have BRIC. BRIC, just BRIC. BRIC is nice because we also have Brazil, so you can see the correlation. And let's have one more. Let's have an emerging market also. Let's have Turkey. We hear a lot about Turkey, but how is Turkey performing? That's the question. It's developed, emerging. Turkey is a developing country. Turkey. We had value. Let's use growth. Turkey growth. Here we go. We update the chart, so it gives us the daily and day data. But for the last 4 years, let's see, once it's loaded, to get a longer time frame. Hope it doesn't take too long. Good. Full history. Update. Full history only gives you monthly, but that's fine. We don't need more. And what you can actually do is click on download data. And let's show the folder. Here it is. And I'm going to put this into my working directory, which is here, which I'm going to call history data, MSCI. Yes. Let's copy this, and I note that I have to first quickly edit this, because at the end there's some copyright information, and if you leave it in, R will struggle at import. Also, you see that data only starts on line 7, so this is what we have to take into account when importing. So let's load the library. All what I'm going to do is I'm using the tidyverse libraries. Also, I'm going to use tidyquant, which is based on the package, what is it called, QuantMod, but in the Tibble tidy environment. And also for loading the data that we just downloaded, we need readxl. Readxl. Yes. So let's call it data. Let's not call it data. MSCI. Wait, read Excel, and it's this file, and we have to skip the first 6 lines, and we also have call names. I think it's default, but anyway, MSCI, let's have a look. Doesn't look too bad, but I don't like the DTTM format for the date, so we're gonna dictate the date equal as date. And if I look again, not found. Date. MSCI, like so. Did it work? Yes, we have now simple date format, which is what I like. First, I'm interested since when we have this data available. No, wait. First, we're gonna put it into tidy format, which is using the function gather. And let's quickly look at the reference, how this works. I believe in samples there is a description for stock data. So we don't have stocks, we have indices, index, and we're going to use value, that's what we call the price, and we have date, not time. So this is exactly what we want. MSCI. Yes, and now this MSCI, let's group it by index, yes, and we filter. And we don't want the non-available is in value, and we're gonna do summarize the start date, let's call it start, is equal to min of date. And you also see, let's also do arrange descending, oops, doesn't work, by start. So you see the latest data, which is Turkey growth. Our data starts in end of 1996. So for simplicity, MSCI, we filter so that date is larger or equal than not 2018, 97, of course, 1. Yes, that's our data. Now, just for the fun of it, let's plot it. MSCI, ggplot, statics, X is state, Y is the value, and let's have color equal to the index, and we have geom line. What does it look like? It doesn't look like so nice in the standard view of ggplot. Therefore we use team tidy quant, which is well suited for this. Yeah, here you go. Now we want the returns, of course, and for this we have to use tidy quant, and wait, we have to again group by index, and we have to tidy quant transmute. Let's quickly go to the reference to see, because again I believe there is a sample. Exactly, here it is. So what we're gonna need is the data. We have it? No, tidy quant get. Where's transmute? Here. This it is. We have to use select. We don't have close, we have value. We have mutate function. Let's also put it in a new line. Mutate function that comes from the quantmod package. Period return. Now as a function, but so period we have monthly, and we type the type. We use not log returns, but instead arithmetic returns, because I believe it's more practical. You actually see what you earn with arithmetic returns, which you don't have with log returns. Arithmetic typo. Here we go. Should run. Perfect. But let's call this returns and dash. And just for the fun of it, let's have a plot again. But let's have only the, not select, we use filter. We only use data from this year. Date larger or equal than 2018 01 and we use ggplot with the statics X always date, Y is the return. Oh, months, I believe. Yeah, this is monthly returns, and we have fill equal to index plus geom bar, and I believe this is stat equal to stat count identity. Does it? Yes, this doesn't look bad, but of course we want a facet wrap over the index, and because we don't like the standard theme of ggplot, we use theme tidy quant again. So here you see the performance of the indices. You see that first months were negative for Turkey, this, Brazil, BRIC. Brazil was positive, Brazil BRIC wasn't in the most recent August. You also have Turkey, which of course is going down massively at the moment. It had -10, I don't know, minus 15 months recently. And this is interesting. But more than this, we're interested in the correlations. And for the correlations, I know there is a function or a graph from the, because wait, when you just do correlation, must be numeric. How is X not numeric? What is this? Ah, yes, of course, you have to spread the data again. So, what do you do? We do spread. And I believe this is in, now let's look at the reference again. Spread, stocks, here. Spread, stock and price, index, and value, but not value, but monthly returns. Here it is. And just so it's nice. We unselect date and we do correlation. Now the problem is that this isn't nice. The names are too long and you don't understand anything. So instead, but let's save this, correlations. So this we don't need. Oops. There is actually a chart, correlations, from the QuantMod package, which gives you this. And you see that this value, what was it? Norway value is very little correlated with Turkey growth. Yeah, 49. Yes, this is world value, and this is Turkey growth. So you see there, you can definitely get some nice diversification from this selection of indices. Now, PCA. PCA, what we do is we take either the correlation or the covariance matrix as a basis and recalculate the eigenvalues and the eigenvectors and the eigenvalues, which are the principal components of the variation of your data. So what the command is in R, we need again this, because we want it as a matrix, I believe. As a matrix, I believe you have to input it as a matrix because it cannot understand tidy format. The PRComp is the function, and PRComp is important that we set scale dot to true, so it scales it, and it center also true. So it actually takes not the covariance matrix as a basis, but the correlation matrix, because correlation, of course, is a centered and scaled version of the covariance matrix. and we call this PCA. Yeah. So PCA, what you get from the PCA, you get the standard deviation, and you get what this function calls rotation, which is the loadings of each variable on the principal component. Now, how you have to understand principal component analysis is that the first principal component seeks to explain the maximum of variation of your data. The second one, the second most, and so forth. You can use the summary, just like any linear model or whatever. You get the standard deviation and you get the proportion of variance explained by principal component 1, which is 70%. Principal component 2, which is at 11%. So you have a cumulative proportion of explained variance of 81.75%, and I believe you get a nice plot from this. What you've just plotted? You get, wait, is this the package that I just installed? Library Factor Extra. Welcome, good. And you can use this PCA contribution. Huh. What was this? Is it this? No. No. This is the individuals. This one will also use later. I wanted this plot where you can see not the biplot call. Let me quickly check in my notes because I know how this works, but I quickly have to go see. Okay, I am back. The function that we're looking for is Eigen, which gives you the scree plot that shows that principal component 1, first dimension, explains 70%, 10% or 11%, and so forth. With additional adding of principal components, you explain more, but relatively to the previous PCs you explain less. Another thing, basically, again, looking at the summary, no, just at the PCA rotation, rotation, also called loadings in literature, are the eigenvectors. What you can also do to see this, that this is actually the eigenvector, is leaves this. Then we use correlation, and we use the function Eigen. Eigen, let's go, I don't know if you should be Eigen value and vector. Vectors, eigenvectors, let's use this. And if you look at eigenvectors, and here you look at the vectors, you see that actually the eigenvectors on the correlation matrix is the first component. You have the same values. Second one, they here have a different, okay, I see, they have, here is negative, here's positive. Doesn't matter, it's a vector, either it points in one direction or the other direction. It explains exactly the same amount of variation. And from the PCA, you have the standard deviations square. These, I believe, are the eigenvalues. Let's see, the eigenvectors and values. Yes, these are the eigenvalues. Interesting characteristic, of course, eigenvectors are orthogonal on one another. You can prove this by PCA vector, rotation it's called, and use the first one. Yes? And you have to transpose, otherwise you cannot multiply. Matrix multiplication in R, PCA, and again rotation on the second one should equal 0, otherwise they're not orthogonal. Yes, it is 0. It has some issue with, and there's also a function for this. Wait. I don't know, there's some function because this is basically 0. Same goes for the third one or fourth one and so on. And I believe, I'm not sure if this will work now. Library RGL? Yes. And you can have vector arrow 3D, and let's draw this. Color is red. I hope it works. Object color not found. Color equal to, here's 1, 2, 3. Let's plot these in a 3D space, and you see that these vectors are orthogonal. Wait, they're not. Because of course, yeah. Well, it doesn't work. Okay, it doesn't. I cannot show this in a graph because, of course, it's not the 3-dimensional data. We have 6-dimensional data. So in a 6-dimensional space, yes, they are orthogonal on one another. In a 3-dimensional space, no, they're not. Anyway, this is not gonna work. But you see from this, you get 0. It is actually orthogonal. And now, how is this going to help us? We're looking again at the PCA output, rotation, and this time we're going to use 1 and 2. We're looking at 2 principal components. Let's look at 3. Let's look at all of them. And you see that the first principal component, all of them have pretty large loadings, except for Turkey. You can understand the principal component 1 as the stock market risk, and the other principal components as individual loadings. So interesting is that, for example, for the second principal component, Turkey has a very large loading, while the others have low loadings or even negative loadings, which means that they are negatively stand in a negative correlation with respect to the second principal component. And this you can also see F this. Didn't we have this? Oh yeah, PCA. No, F this. The variable plot. Here you see, and I think of the balance, then you have the names one apart from the other. So you have the dimension 1, principal component 1, which all of them are positive, have positive loadings. The second dimension, principal component 2, Turkey has negative, Brazil has negative, BRIC has negative, while the world, Norway, all country world index, minimum volatility have negative. So you could think of dimension 2 maybe as an emerging market specific risk indicator. And with respect to PC3, I'm actually not sure. Maybe you could. Yeah, PC3. You have, which is the largest? 6. Brazil has negative loading, as well as BRIC. Of course, BRIC and Brazil is correlated, so it's no surprise that on their specific risk they are correlated on principal component 3. And what the guy from the book, Multidimensional Diversification, suggests is using Varimax rotation on your output. So that's exactly what we're gonna do next. Varimax rotation. PCA, and you do Varimax. Varimax on the loadings, on the rotation. But we don't want. Let's for simplicity use 1T3. So you see that they are of course loaded on the on principal component 1, 2 for Turkey, and 3 for Brazil, BRIC, and interestingly Norway, beside being loaded on principal component 1. And this could be interpreted as Norway value having exposure to oil producing, which is a similarity they have with Brazil, which is also producing oil, as well as all other BRICs like Russia especially. So what are we going to do next? Next, we're going to build a portfolio. So what you could do is, of course, have the most simple of a portfolio, which is just equal weight all of these assets. So that's what we're going to do. Tidy quant, No, it's returns, and we use tidy quant portfolio. Let's again look how this works, because I don't know by heart. Tidy quant portfolio, data, asset call. Asset call is index. Weights is null, then I believe you have equal weight. Can you do like this? Just type 6. Yes. I just want a 6th on each. And it's called rename. What is called rename? Index call. I don't know. Let's see what output this gives. Must be strings must match column names. Returns column. Returns value. Okay, this is a bit more complicated, it seems. Weights we have. Tidy quant portfolio. Monthly returns. Yes. Asset call. Index. Yes. Returns column. Monthly returns. Because it's not value, it's monthly. Monthly returns. And you get the return of this portfolio. And let's do. Wait, how am I gonna do? Okay, maybe I should have researched this before. Anyway, let's use tidy quant performance. And again, I have to look this up because I'm a noob. Tidy quant performance. Where is the performance function? I believe it's annualized. Oh, it's table annualized returns. Table annualized returns. Oops. Yes. What does this give? Portfolio return. So over the since 1997 monthly return, you get annualized. You get 4.77%. You get a sharp, and you get a standard deviation of 22, and the sharp ratio from 0.2, which was a risk-free return of 0%, which is of course not a right assumption for the last 30 years anyway. Now, according to to the very max. There's no point in investing in Brazil, BRIC, and Norway, and to invest in in minimum volatility and world, because both have big loadings. So even though you have a large diversification in the number of assets you invest in, you could be worse off by investing in so many assets than by investing in less. So what we're going to do is we're going to invest in 4 assets. We're going to invest in minimum volatility. Oops. One, we're going to invest in Brazil. One, we're going to invest in BRIC. I don't know, there's no point in investing in BRIC. Let's invest in Norway. 0, 1, and last but not least, we invest in Turkey. Norway, Turkey, 0 divided by 6. I believe this should work. By 4, because we have 4 assets. So we get a whopping 4.9% return. We get actually a lower Sharpe ratio. So this is not what we want, of course. But overall, you could say, you can argue, you get a larger return, you get almost as good Sharpe ratio, and a bit higher volatility. But you have to invest in less assets. So you get almost the same by only investing in 4 assets, because you wiped out the ones that are not adding any value. More crazy this is actually when you have a portfolio that the portfolio manager suggests you to invest in 2 stocks or indices that are very high correlated, such as he says you have to invest in the MSCI World and the MSCI Small Cap, or the say MSCI World and Small Cap, and you have to invest in value because Pharma French says that you have to get the premium. You will see, performing this analysis, that this is pretty much pointless to do so. So yeah, this is my very short introduction on PCA in portfolio diversification, and my very first video of this kind. Thanks for watching. Goodbye.